Hey, and we're live. It is Wednesday, July 22nd. It is just gone 6 p.m. Eastern. Google have just reported, and we have got Kevin Muir, the macro tourist, joining once again on Benny and the Squirrel. Hey, Kev.
Hey, guys. Great to be with you. I'm looking forward to this.
Welcome back, buddy.
Everyone knows who Kev is, but just to re-emphasize, Kev writes the inverse Playboy. You know how everyone used to say that they used to read Playboy for the articles? Well, they read the macro tourist for the pictures.
That's right. I actually have like old clients that originally started and they said, I would just read, I make sure that I looked at every single one because I liked your picture so much. That was always the thing. He said, I don't have a clue what you're talking about, but I still like the pictures. So that was always the joke about me, come for the
That's
pictures.
good.
Hopefully you'll learn something about macro.
Are important. I'm the visual guy of the dynamic duo that is Benny and the Squirrel, and Rupert's hanging on to the old model. He doesn't want to endorse the new era of like visuals.
No. Just overdoing it from time to time on the AI slop. Anyway, listen, talking of AI slop, Google has just reported.
Good segue there, buddy.
Good one. That was a good one.
And actually, just ahead of the show, Benny had the perfect summary. Go on, go for it, Ben.
Yeah. Well, it's funny because I have a WhatsApp chat and that I have my LPs and some of my subscribers on, and a lot of PMs and buddies, and I message them because on another one, guys like, 89% revenue growth, and then I pulled up the stock chart, minus 5%, and like all we've been talking about is, hey, they're officially negative free cash flow now. And so negative free cash flow. And the fact is they up their CapEx guidance. Mark's like, we're not interested in this. We're going to take you down a notch.
Yeah. And this is the problem, right? Is that we've sat here and we've seen the hyperscalers lose the confidence of the market in terms of how much they're spending. And I really like thinking about this. I love that Ben Inker piece from GMO, and he talks about an earnings bubble. Yeah. And the more I think about it, the more I kind of enamored I am about that kind of theory. And one of the things is that everyone will say, oh, but the market is cheap. Oh, but earnings are going up. And they'll give you all these things. And then you stop and you think about the earnings that we're experiencing, and you stop and think about this AI that we're in. And let's just take Google and Microsoft and Meta. When they go out and they, borrow a gajillion dollars and promise to go build all of these data centers, the market goes, that's terrific, or used to go, that's terrific. Look at how much money they're going to make in the future, right? Like, so they would sit there and go, okay, we can crank the earnings in the future because they're spending so much today. In the meantime, they're going out and they're all doing this. So they're competing and sending Micron to, 89% margins, NVIDIA to some crazy margins. So those companies are also printing money, right? And so it's just been this kind of competition to spend money. And as they've done more and more, it's just increased the bubble that is the earnings. And all that we've done, though, is we've made it so this expectation about how much AI has to make in the future so large that it just seems to me that when you're stepping back and thinking about an investment, whether the concept or the theory about the underlying technology is right or wrong is irrelevant compared to the price you pay for that. And there are times when a bet is just so one-sidedly expensive and stupid that it makes sense to go the other way. And I always use like Super Bowl examples, right? Like, let's imagine some team, your team is favored, and it's all of a sudden it's like, 20-1 is all you're going to win if you win. And you could still believe your team is going to win. And you could think to yourself, I think it's 75% chance that they're going to win. But if it's priced at 20-1 and all you're going to win is some measly tiny little amount, it's a dumb bet.
It's a negative convex bet. It's a negative convex bet.
And that's where we are right now on these things. And there's a million other problems with it. But I'm just shocked at how many folks will, the moment you say anything negative about it, they call you a grumpy old man yelling at the cloud. And you're like, no, you know what? Like, all your theories about why this is going to change the world and why AI is so important actually ensures that it is a terrible investment. If you go look at history, the more sure a bubble is, the more likely is that it's going to be overcapitalized and actually experience, negative returns for the investors. You go look at railroads; they were terrible. In Rupert's homeland there, there's a Downton Abbey about how much money they lost there about that. Internet, nobody made money for 10 years, right? Like, you just go through it. And like electricity, I think it was the same deal. Or maybe, like, I think phone company was the only one that was actually decent. And the reason was that there was a monopoly it was kind of not allowed. There was no true competition.
They were piggybacking off the railroad infrastructure largely with the transcontinental cable companies.
I didn't realize that.
That's right.
So in a way, it was kind of like the second mouse that got the cheese.
Right.
Exactly.
Yeah. And listen, we all know all the negative stories and the whole thing about the dark fiber. The reality is that, the internet bubble, it created this huge build out that actually, I correct me if I'm wrong, Rupert, but I think there's still dark fiber that hasn't been lit up. Like, there was that much fiber
20%.
created. Yeah.
20% of fiber today is literally fiber that was laid back then.
Right.
And it's still,
it just goes to show you how wrong they were, right? Like, and this is what I love when young guys tell me, oh no, you don't understand. This technology is different. This truly is different this time. And I'm like, you don't think that they thought the same thing during the .com bubble? It was the exact same arguments. And yes, this technology is different. I understand all the reasons, and they're going to tell me how it's this one actually thinks, and this one does this and that, and like that. It's always the same story, right? Like, that's the thing. As you get older, you realize how often these stories just play over and over and over again. And I don't know about you, Rupert, but I thought I would never see a bubble like the .com bubble again, and yet here we are.
Yeah, I know. I can't believe I'm so lucky to have lived through two of them.
Well, buddy, we should. Sorry, go ahead, Betty.
The thing that I'd say is, I'm writing a paper about comparing the Japan. I'm writing all these papers about historical bubbles against the current bubble, and I'm doing the Japan one now. And there was a paper that came out, and these guys are like the necessity of bubbles. And there was I referenced this in our last pod, like a book by this guy from Franklin Templeton. You need the bubble to attract the capital in order to figure it out. And so this is actually how the system needs to work. We need the bubble.
Okay. Well, and I saw a very prominent ex-hedge fund or ex-sell side, maybe worked for a hedge fund for a little while, newsletter writer talking about this is all noise. Think about the .com bubble. Put your, earmuffs on and power through this, because it's ultimately it all worked out. And I thought to myself, that's so disingenuous, because stop and think about the returns of the NASDAQ post the 2000 crash. It was down 75% or something like that. The index, not an individual stock, the index was down 75%. It took 15 years to make your money back. So all the folks that are telling us how transformational the AI is going to be and how it's going to change the world, they very well might be correct. And I'm like, I don't even need to argue that. All we have to argue about is the price that they're paying. And the fact is that this looks increasingly like the .com bubble, that it's going to be very difficult to make money. And just be aware that just because you're right on the technology doesn't mean you're going to be right on the stocks.
Yeah, I think that's absolutely right. I mean, but Kev, one thing that we sort of began to touch on, which I think is really important, is, and the reason I wanted to start with the Google earnings is that the other thing that we're all being browbeat with at the moment is, well, look at the forward EPS.
Yeah,
the market is simply following the forward EPS right now.
Right,
and I say that's great, but you did some great work the other day. So much of that EPS that we're seeing right now is marked up gains on investments, and you actually did the work to build this up. So let's talk about this analysis that you put together a couple of weeks ago on real earnings.
So I stumbled upon, I can't remember, I think it was a professor had written it, and I'm like, he had gone and highlighted how this thing called the OI&E, other interest and expense, how this category is usually other income and expense. It's usually just a rounding error, right? It doesn't really matter. It's up and down small amounts. And when you're looking at the index, you just kind of ignore it. And it's in essence, companies, for whatever reason, they have a gain or a loss that they can't categorize in the regular accounting, and they shove it in here. And he highlighted how there was these three massive gains by Amazon, Google, and Meta. And they were big. Like Google, it was 35 billion or something. It was some monster.
28, I think. 28 billion.
It was 35 and a quarter, maybe. I can't remember. Maybe it was 28.
Q1, I think it was 28. 28 to 35, whatever.
Okay, matter. Whatever. Maybe it's 20. It was a big number. So I went and found all of them and listed them. Sure enough, if you go through like the last 20 years, 8 of the largest ones have occurred in the last couple of years, right? Like so this is happening. And what we're experiencing is Google's sitting there and they have, I don't know what it is that they own, Anthropic or SpaceX or whatever it is. There's some, and it's probably not even SpaceX, because I don't think they're actually realizing these gains. It's just a marking up of their positions in an equity that they own, right? And it's massive. And one of the things that I think is interesting is that, as I mentioned before, when it's a small amount, it really doesn't matter, right? Like you kind of just throw it in there. But this was like 25% or 30% of the growth in the earnings is the result of this. And the part that really kind of rubs me the wrong way is the market is not differentiating that, and they're putting the same multiple on that crap, right? So like, it's fine to say that money is money and that it deserves to be an increase in the price of the stock, but it doesn't deserve the 20, the 20 multiple that the S&P trades at, or the 22 multiple it used to trade at.
Absolutely. So it's just right. The original Goldman Sachs post-IPO, right? The market would never give them a multiple on the gains on principal trading, right? Similarly with Blackstone and the other alternatives shops. So if the market was sort of sanguine about that then, why on earth are you going to say, okay, look, Google's just beat, expectation was $2 a share, they did 9. I suspect most of that 7 was unrealized gains on investment. Right? Why is that worth more than a turn of valuation?
Well, because I actually think the market has gotten less efficient, Rupert. Like I really do believe this, and I see Cliff Asness from AQR talking about this all the time, and I'm a little bit of the belief that yes, I'm in your camp, Cliff, but your folks are part of the reason that this has become this way, and it's the success of quant trading and quant investing has made it so that there's less and less actual just old school trying to buy cheap companies, selling expensive companies. And it's more and more of these quant traders. And so often I think that a lot of these strategies are, they're relatively new, some in terms of some of them. And like when you're thinking about the grand, like when we're thinking about trading over the last 50 or 75 years, a lot of these strategies are new in terms of how long they've been going. And so I kind of think back to the quality one that always kind of makes me laugh, because the quality strategy is like you go out and you buy a company that has very, a steady increase in earnings with little variability. And if you buy that portfolio, it tends to outperform. And so Costco is like the poster child of the stock. Yeah. And the trouble about this strategy is that there's no valuation kind of, trigger in terms of saying, okay, that makes sense when you're buying a company for the same multiple as the market or even cheaper. Like you used to be that Costco traded cheaper. But when everyone does this quality strategy, it kind of builds upon itself until the next thing you know, Costco's trading at 50 times earnings. Right. And there's just nobody's.
It's because the quants haven't built a co-op factor yet.
Yeah. Like and so I going back to this EPS and bringing it back to the Google point of this thing, I can't tell you the number of guys that I meet that just say earnings are going up. Don't be such an idiot. It's going higher. And
don't fight it. Earnings are going up. You're an idiot. Yeah. You get a lot of that.
And that is very common. And I don't think enough people are stopping to think about what they're paying for those earnings. They're not stopping to think what they're made up of. They're not thinking about whether those earnings are self-reflexive Whereas what I talked about in terms of that GMO fellow that's bringing up that as you do more and more of the spend, you're increasing the earnings and you're increasing the risk to it. They're not thinking about all the debt that's going into that. And, I think you guys touched upon this earlier. Google for the first time is officially cash flow negative. Is that right, Benny?
Yep, that's exactly right.
Right. And let's just stop and think about this. It used to be that everyone would tell me, oh, don't be such a negative Nelly when it comes to the AI stocks. The reality is that it's getting funded out of cash flow. Well, it's not. Okay. It's completely gone, the cash flow now. Not only that, I'm calling BS on all these SPVs, right? There's nothing good that comes out of SPVs.
Yeah.
There's nothing good. The only reason you do an SPV is because you want to hide something, right?
You want no recourse, right?
Okay, but
Except that's not even true, right? Some of them are non-recourse. Truly non-recourse. But there's plenty of fine print to solve through, right? They're not going to.
They're definitely helping their earnings today. Regardless of whether we're talking about who bears the risk, who knows? Like a lot of them are complicated and stuff like that, but they're definitely helping earnings today. And that if all of a sudden this spending goes the other way, then all of a sudden a lot of these things, the earnings will disappear. And then the other thing that we have to touch upon is this token maxing. And I believe that the market has underappreciated the insanity of the tech companies over the last 6 months. And so just for those who don't know, there was a point when all these tech companies were saying it is so important that we use AI, and they drunk their Kool-Aid. They loved it so much. They were pushing their employees to use it because they thought the more we use it, the more productive we'll be, right? And this also goes to this whole thing about Mark Zuckerberg says, I can't afford to not be there, right? The idea that someone else wins is just an existential threat to them. So that, they talked themselves into this lather in terms of AI is going to be so great. And so they made it so that they encourage their engineers to use these tokens to the point where some companies were making leaderboards and which engineer could use the most. And they were getting bonuses based upon this. Well, you give a bunch of smart engineers an incentive like that. It's Charlie Munger says, show me the incentive, I'll show you the outcome. Right. And there's this podcast that I love watching. It's a woman named Elle, and she's a computer scientist. And I love this line. She says, measuring how much AI an engineer is using is kind of like paying your real estate agents based upon how much gasoline they use, right? That is in essence saying, if you're using more gasoline showing clients, you're going to be more productive. Well, maybe you're just going to drive around everywhere and it's not going to be productive at all. And I think so bringing this back, one of the things that occurred in the markets in March, early in the year, kind of as Trump was going into the war, we had this situation where, the market went no bid for a little while. We had the JP Morgan whale. It was a lot of negative selling. And then all of a sudden, all those AI stocks took off. And I have to give Warren Pies from 314 Research tons of kudos and credit for this. He started watching the amount that the GPUs were using. Basically, you can measure how much, people are using AI. And he saw it going bananas. And he said, listen, I don't know what's going on. I don't understand it, but the demand is way higher than we ever expected. So he got long the AI stocks. Kudos for him. It was a great trade. It was the right call, especially under that time frame. But now what I think was happening is that we've kind of been tricked into this utilization that's not real. Right, as going back to this maxing.
There was that famous Goldman chart about token usage that was a parabola hockey stick going out,
and they all just assume it's going to continue.
And we're extrapolating the token max. Right?
And I think what you're seeing already is the companies have pulled back. They're saying no. I saw Chamath, and listen, you could probably guess where I come down on Chamath. So I'm not even going to bother saying it. So it kind of, hurts me a little, kills me a little inside to say he might be correct here. But he was talking about the fact that when he's looking at his portfolio companies, he's going and looking how much they're spending on AI. And I can't remember what he said. He says like it's going up 45% a year or something like that. And he says my productivity is 5%. Like this can't continue. And so one of my big worries is we've all been tricked into believing this demand story because of, of this token maxing and a whole host of factors that just came together. And we're going to look back and we're going to say, hey, wait, this isn't growing anywhere near as much as we thought it was. And I'll just remind you back to the dot-com bubble. Although no one really can agree on what caused the cracking of the dot-com bubble, one of the theories out there is that there was this Gartner report. And the Gartner report, all it did was say, instead of the internet doubling every 180 days, it was doubling every 270 days. It was something like that. It was just
a quarter or a 6 month mismatch.
It wasn't that big a deal, but that change in growth rate was enough to everyone to go, hey, wait, wow, we might be overdoing this. And what I worry about is that when we look back, we'll realize that we were tricked into this demand. And I really think this earnings season is going to be wild, because I suspect what we're going to see is a lot of companies not being, if they don't, they're probably going to meet expectations because everyone manages to meet expectations. But I think that the forward guidance is going to really set the tone. And it wouldn't surprise me at all if this is the top.
Yeah, I mean, I totally agree. I was saying that in June. I was adamant that was the top, like adamant. In the reality is the token maxing thing came about because you had Mythos come out and they're like selling it like it was Skynet. The guy who used to be a former OpenAI guy who's the head of strategy and marketing at Anthropic now comes out, and that was it's dangerous. It's dangerous.
Nothing so better dangerous to sell than to say it's dangerous.
And then what happened since then? You basically had a situation where a whole bunch of other models caught up. And as Rupert and I have talked about, that moat is just not that big. They got worried about it, so they had to delay it. And then, now it's included in the subscription models. It's like, man, these are commodities. And yes, they're great, but they're going to be commodities. And that is just, we have a lot of backlog in all the cloud guys. I think it's over 50% of the backlog is two companies that don't make money. And by the way, let's be clear so everyone knows, token prices are down like 99% in 2 years. So that's happened. And they're still losing money. And so I think the key thing to talk about is like Coinbase CEO comes out and says, hey, our token spend's dropping, but our token consumption is still going up because they're optimizing the system. They're putting harnesses on, they're using the memory layer, they're doing less caching. And so this is what's going to happen. And this is what happened in the 1840s railway. Revenue per mile. It was based on this assumption of unlimited traffic, which we can talk about in the same thing with LLMs, like unlimited demand. Okay, well, what's the unit economics on these things? And I think that's where the rubber meets the road.
You don't understand, Benny, though. Like, it's going to replace humans. Don't you realize it's going to? By the way, when you said the dangerous, I thought, I remember, what was that Porsche that they made in the 80s that was convertible? Sorry, not convertible. It was a turbo. And it just started killing everyone because it was so fast. Too
hard to drive.
Yeah. And it was so hard to drive. I was like the greatest ever, people killing themselves. And this was probably the greatest piece of marketing ever.
But that's actually the right analogy. I talk about that in the AI company I'm involved with, is like an LLM is like an F1 engine, very powerful, but you need a good driver like Lewis Hamilton, and then you need the back end, and then you need the engineers. You need to have a whole infrastructure behind it to make that thing work.
Okay, Kev, let's dump AI for a second. And I think this is the moment when Ben, and to be fair, the market gets to say why we've all been so wrong on the yen. Welcome to Yen. Welcome to Yen Bulls Anonymous.
I heard that you and Betty go toe to toe about this all the time.
This and the RMB. He's got me so far on the RMB. He hasn't won yet, but
okay.
the yen. I'm a massive. although I am sympathetic, Kevin, that there is a moment when it's eventually going to turn. Like, and I think we're getting close. We're getting close to the point. So, like, I think we have one more move, like 170, 175, and then it's going to make the BOJ do something, essentially.
So you're not in the, but well, listen, the true yen bears, of which, there's a certain Scottish one that is very,
I'm a speaker at his conference in a week. I know
there you go. The true yen bears believe that the BOJ can't fix it.
So let me tell you why that is, because I'm writing this essay.
Okay.
So when you take rates up, the interest on excess reserves, which gets remitted to the MOF, is going to go away the way it did when the Fed stopped paying the Treasury, right? So that's you lost a line item of revenue that's now gone, makes your fiscal situation worse as your cost of funding is rising. And that's the actual,
and that's why we go to 250. It's dogs and cats living together. Japanese don't have a chance. It's going to 250.
No, but I'm just saying.
Can I tell you why I think that's not going to happen?
Yeah, go ahead.
Okay. I believe that the market has completely and utterly underestimated the power of the Japanese government to change the way that money is allocated and saved in Japan. And that is actually, I don't even think that the Bank of Japan needs to get involved to fix the yen. I think it would take one thing. The Japanese government goes and says, you know what, GPIF, right now your portfolio is 25% domestic stocks, 25% domestic bonds, 25% foreign bonds, 25% foreign stocks. I want that to, 10% foreign bonds, 10% foreign stocks, and everything else domestic. And what happens then is that the GPIF is on the offer of USJPY for decades. Well, not decades, years to come. And it's huge. And one of the things that I get kind of frustrated with is that people forget who has the money, who has the capital in this system, right? Like I hear all the time, oh, well, the US is in the catbird seat. They can dictate the terms. And I'm like, the US is the largest financial creditor in the world. And yes, right now, everyone is throwing money into the US and money is flowing into the US at an absurd pace. And yet you and I and Rupert have just sat here and talked about what a bubble the AI is. And why do you own the US? Like the reason to own US is because it is the greatest technology country in the world. And when you go and start to think about the potential unwinding of that, I think you're going to see massive, massive selling of US stocks, and the money is going to come home. And when the money comes home, the countries with the most savings will see their currencies rise.
Well, I would say this is one of the things I was thinking about for the Vol Fund was non-obvious derivatives of what you're talking about. And there is like a convexity trade of being long yen, bullishness. So puts on dollar yen, and against like Korean won and the Taiwan dollar. Because if this rolls, then basically it all kind of happens at once, right? Like, so money comes back to Japan, it comes out of Korea, it comes out of Taiwan.
So I got a better trade for you than that one, because I think Korea is in fact doing the same thing as Japan, and I think I'll take you back to December 24th when the Korean government snuck in a little rule while Trump wasn't looking to change the tax rate to bring money home in their attempt to go and actually stop the won from going down. So they encouraged money to come back. And in fact, they were part of the reason that might have even fueled this bubble in the stock market. And I'm not sure, yes, there are some foreigners buying the Korean stuff, but I think it's actually mostly domestic. Like, I think that is the Koreans doing this crazy stuff with maybe some Chinese, because they have that 7709 ETF and things like that. Rupert knows more about that than me. But here's a trade for you, though, if you want to do cross rates. I think the Swiss franc Japanese yen trade is the one to short. And hear me out on this. So the Swiss and I've gone and tried to find some documents for this, and it seems to be that this is correct. They're notorious for having higher hedge ratios. And when you go over for the American listeners or the North American listeners, they don't realize when they go to Europe, all everyone wants to do is talk about their hedge ratio. Like I was just like, what? Like it's and when they talk about hedge ratios, we're thinking they mean hedge ratios as in terms of puts and protecting their portfolio on the downside. No, they're talking about their currency exposure, how much they're letting ride in terms of exposure to US dollars, right? And so they talk about their hedge ratio. So a lot of folks just let it ride. Like the Japanese, the GPIF, it's almost zero in terms of their hedge ratio. But the Swiss are much more prone, and I think it might be a regulation thing, or maybe it's a cultural thing. They are much more prone to have a higher hedge ratio. So if you think about it, as their US holdings has risen, like as their US stocks have risen, that means they have more US dollars. So they have sold US dollars to buy Swiss francs. So if you actually overlay like the Swiss franc yen, it looks remarkably like the AI trade in terms of the chart. And so if we get a situation where this thing turns on, south, and people actually start selling their AI trade, and we see a situation where the holdings of the Swiss are actually declining, that means that they are going to have to, let me just get this right, before they were selling US dollars. So now they have to buy back those US dollars. So they're selling Swiss francs. And then if we get a situation where the trade is going down, I happen to believe that a lot of the Japanese, these NISA accounts, NISA, I don't know how to say it. Is it NISA, NISA? I think that they've been fueling a lot of it. So when we get a situation where this finally turns, like momentum turns, they're going to be selling it, and they're going to also be buying back yen. I think part of the reason that the yen is so weak is because we have this situation where the Japanese retail just keeps buying more and more AI stocks, right? Like,
it's been happening longer than that. Let me bring this up.
Okay,
I didn't overlay this, but like if you look, and again, I'm writing this essay, but like 2011 it was a double dip, right? Like if you guys remember, October 2011, the S&P was 1100. Everybody was negative. I was a mega bull and a mega yen bear. And I've been a mega yen bear for 15 years. And it's been the right. But if you overlay this with the Nikkei, with the NASDAQ, with whatever, like this chart is what it is. So you're right, is if this rolls, it's much bigger than just the yen trade. So like this money comes home, and this is money like Rupert likes to call it the Saudi Arabia of savings.
That's a good line. That's good, Rupert. That's a good line.
But this chart kind of tells you, it's like, we bottomed out, forget about the de-averaging of 08, but like, the true bottom in the equity market, in my opinion, was that fall of 11. And then since then, you had you had Abe come in with Abenomics, and I was like, oh my God, this is going to happen. And long Nikkei, short yen was just a golden thing, and long NASDAQ, long anything, Mexican peso, whatever it is you wanted. So I agree. This is the mega macro trade. And it's one of the things that probably a lot of people outside of the macro world don't think about at all.
Yeah, let's think about, if this does happen, what kind of where is the damage worse in risk assets elsewhere in the world, right? I mean, you've got the obvious unwind of those, Mex yen carry trades. Yeah, that's easy. That's the first thing to crumble, right? But you've got sovereign rates markets all over the world where Japan is the biggest lender into those markets. Down here in Australia, that's top of the list. You've got the Netherlands. This is back to the sort of Hunger Games conversation that we talked about with Dave Dredge last week.
Can I push back a little on that though? Because I think if we get a risk off move like that, I think it's going to be accompanied with an economic slowdown.
Yes.
And And, my buddy Cuppy says in the old days, recessions cause stocks to go down. Nowadays, stocks going down cause recessions. I'm not sure how correct he is about like that specific thing, but I think that they could both happen at the same time. But I find myself having trouble to make the case that we're going to have trouble funding stuff. Like I really, truly believe that, Rupert, it pains me to say this, but like, do you know any bond bulls out there anymore? Like there's a very famous one. Okay, Benny. Yeah,
I work with one. I work with one.
Well, I'm actually one as well. And you know me, I have been the biggest bond bear out there. And I just look around and I'm just like, you guys, you guys have missed it. You guys are getting bearish at the wrong time, right? And they'll be like, "Oh, you don't understand this. You don't understand that." Like, I love telling this story. I wrote this piece for Bloomberg, and they were, foolish enough to have me, in their Bloomberg op-ed, and it was in late 2021, early 2022, and at that point, I think it must have been early 2022. We had the first down year in the bond market, right? And one of the things is at that point, we had never had 2 down years in a row. Like never, right? Like that's the part, like or maybe not never, it had been like many, many years. And I wrote this piece saying like, oh, this actually could be a really big deal. And we could see for the following reasons. I explained fiscal and all these things. And you should have seen the resumes of the people who, wrote me letters to tell me what an idiot I was and that I didn't understand that the bond market was bigger than anyone else, and that the reality is that people that have been calling for the end of the bond market have been made fools of it. And I would certainly learn the pain of the bond market very shortly. And people forget, but when we started raising rates, up until this cycle, every single rate hike cycle had a lower peak. Right? Like in 1982, we lowered rates from 15 to 8, then rose them to 14 or 13 the next time, lowered them to 7 or 6. And it was this series of cascading, lower highs and lower lows. And this was the first time that we had ever seen an actual higher rate peak, right? And I find myself now kind of just laughing because it's people that were, criticizing and telling me I didn't understand the bond market are now telling me how it has to go a lot higher in yield. And I'm just looking at this environment and I'm thinking everyone is just full on in their stock market. When you look at the Bank of America Fund Manager Survey, I think only 2% of people believe we can have a hard landing over the next year. Like contrast that to 2023 when everyone was convinced that we were going to have a hard landing. And it was like we had never seen the surety that everyone thought. And now we have this situation. Oh, Trump will never let it go down. This will happen. This will happen. I'm like, you guys, the reality is that there's business cycles. And that's the part that really bothers me is that people are just now completely and utterly convinced that there's no business cycles. Like and Rupert, like I just had our good buddy Paul Craik on the show, and he's telling me how the business cycle is dead, and I'm like, okay, like it's a good theory. I'm going to take the other side. I believe that the business cycle isn't dead, and that we're going to have one, and it's going to be brought on by our excessive spending in AI, and it's going to be made all the worse by all the leverage and all the grift and and all the promotion. And one of the things that scares me is that, like, when you don't allow short selling in markets, it ends up being that the bid is much lower because there's no natural buyers. At the same time, when you encourage speculation and make it so everyone's scared to short because everyone's convinced, it means that the bid is way lower. And so when this finally turns, I think it's going to be ugly.
And the other thing, Kev, is that the positive autocorrelation of the underlying mechanics, like my buddy Mike Green, he's done lots of work on this. And like we were just talking the other day about these double levered ETFs. And like people don't really understand how much impact those things are having. Like just give you an example, Micron, right? Micron double levered ETF was adding 5 billion of incremental flows a day. So like, if the three of us were like, let's go start a hedge fund. And our strategy is buy Micron, and we're going to execute on day one. And then there's another group of guys the next day for 90 days in a row.
Yeah.
And, you know, I know 5 billion sounds like it's not that much, but it is a lot.
No.
And so then on the other side, it unwinds. And then, by the way, everybody's price momentum chasers. So like this thing can, I'm just telling you.
Funny you should say that. Kev's got a picture for that.
Yeah.
Good.
So I actually wrote a piece about about the double and triple levered. And I was just explaining to people the dynamics, because I don't think people understand how they work, right? They buy this ETF. They think that, you know, if Micron goes up, you know, 20% over the next month, they have a triple levered Micron, they're going to be up 60%. And what they don't realize is that they're not actually buying the return triple levered over that period. They're buying the triple levered daily returns. And that daily return means that each and every day, that fund is rebalancing.
Yes.
And so as it's going higher, they're buying more and more to maintain the proper amount of leverage. And as it's going down, they're selling. And one of the things that I completely agree with you and Mike is that this explosion in the amount of assets under management in these things is just distorting the market. And one of the things that I would like to just highlight is that we all know, like the JP Morgan option whale, how when a client position is large enough, it actually creates the volatility around the strike, meaning that when we rally up into the strike, that the JP Morgan option whale, that all the market makers are long, those market makers are long what's called their long gamma. So they're buying as it goes down, they're selling as it going up. It's having a kind of an effect of dampening volatility. They're hedging around that strike, ends up being a self-fulfilling prophecy. The client ended up selling tons of calls there, and the volatility around that call ends up being dampened. On the same way, on the downside, when we go down to the put that everybody is short, it has an expanding volatility because what happens is the market makers need to sell as it goes down, and they need to buy as it goes back up. So bringing this back to the triple levered ETFs or double levered ETFs, they go and they buy more as it goes higher, and they sell more as it goes lower. We are, in essence, making the world short gamma. All these markets are becoming more and more short gamma. And so this is causing the markets to be much, much more unstable. And here's another thing I'll point out. Recently we had, it was a small ETF. It was Lucid. And Lucid had this double levered ETF. And it was just a couple $1 million or something. But I think that the example it sets is good to know. We had a situation where there was a rumor the Lucid was going bankrupt. All of a sudden, midday, just in a snap of a fingers, it went down 50%. At the 50% point, the double levered ETF is actually technically insolvent, right? So you're sitting there as a trustee and you're like, what am I supposed to do? I need to unwind this. What does unwinding it look like? It means it sells the assets in the actual portfolio, hopefully for more than the loan, but often case it isn't. In this case, it was actually minus. So they lost some money because they sold it for less than the loan, because let's not forget, it's a double levered ETF. So they're borrowing for every dollar, they're borrowing another dollar. If the Lucid goes down by 51%, the trust, somebody is on the hook for that extra 1%. And it's not the holder of the ETF, because the ETF, you can't go negative pricing, right? So it's somebody else's extended that credit. Point is, if we get a situation where something truly bad happens, and I don't want to even say it out loud, but let's just imagine something really bad happens and the market gaps down. We have so many of these double and more importantly, the triple levered ETFs, that we could get a situation where not only do we have the negative gamma that you're talking about, Benny, in terms of those need to be sold at the end of the day, but we could have midday, all of a sudden, this gets triggered. Boom. All of a sudden, the Soxel was a $35 billion ETF, which is the triple levered SMH. Well, the SMH can go down 33% in a day. That's not unusual, especially if something really, truly horrible happened. So they get, halted. All of a sudden that gets sold. Then all of a sudden the market needs to digest that. So something else goes down, and it's this kind of cascading thing. So I worry about these triple and triple levered ETFs. And to me, it feels very much like the portfolio insurance in the 1987 that everyone just thought, oh, no big deal. There'll always be liquidity for this. No big deal. And the other thing I will say is if you're sitting there and you're owning one of these things and all of a sudden it's down 28% and it's a triple levered, don't think that the sharks out there that are like the big hedge funds,
we're going to push it over the edge.
Well, and that's a good point, because you think about who benefits. And just before I say that, let's remember there's also an enormous amount of leverage from the OCC, right? The Option Clearing Corporation. Yeah. So there's this kind of trigger then triggers that leverage. So you have that leverage there, and you have the repo leverage, which is an enormous amount of leverage they're funding all these total return swaps and all this stuff. So you have so much embedded hidden leverage to the average investor, right? Like we're, institutional guys, we understand this, but like not everybody does. That all can cascade. And then you know what happens? People sell because that's just what they do. And then they're like, oh, my trend following system, it broke my moving average trend line, and then they sell. And then the guys who are like the longer term guys are like, well, you know what? I don't really like how the chart looks anymore. And then my old firm Fidelity's selling. And just everyone's become a price follower for the most part. And look, as a guy who does the opposite, I can tell you it's a lonely business.
Yeah. And there's and that brings me back to my point about the markets being less efficient, right? The reality is that in the old days, like I remember when something like when a growth stock changed and it broke, I sat on an institutional desk. I distinctly remember having a day when this stock that was a growth stock broke. And then all of a sudden there were some big sellers, like Fidelity's a seller and stuff like that. And you had to go and convince the value guys to get up to speed on it and get the trade done, right? Like, and I remember them like going like, okay, guys, this broke. Go ask, Bob, if he can get up to speed. And then you'd spend all afternoon getting Bob up to speed so that you could hopefully print a stock later in the afternoon, right? Bob doesn't exist anymore.
Exactly.
Like, that's the problem, right? And not only that, like we haven't even started talking about the pod shops. And I love the pod shops, and it's a great thing. And they managed to make their clients tons of money, themselves tons of money. And like they're all my clients, so I love them. But the reality is that they are also chasing like VAR sensitive, right? And they have to, just by the way that they're set up, they need to degross in a VAR event. And then listen, Benny, you got me started. Like, this is why I'm so negative and worried about the market. How about that implied correlation in the S&P? Like, that is just batshit crazy how low it is. And so there's all these things. And then like, just look at the sentiment. Everyone's telling you how everything has to go up and everyone's so bullish. So yeah, I don't worry about funding because I think there's going to be a market accident.
And you know what you got to think about? Rupert and I have talked about this offline, but like Korea is the leading market of the world right now. I think we can agree on that, right? And so if Korean market has now just recently banned these levered ETFs, maybe that will come home. You know what I mean? Like that will be the lead, as it's been the leader in price. It could be the leader in like, oh, maybe those guys know what they're doing. Because
that's just LIFO, right? They were last into the trade, last in, first out. Right.
Well, you know what? Maybe they realize they're like, hey, I don't want to play with, steroid cocaine induced fire.
But isn't that more a function that their clients are just like complete degenerate gamblers, and that it's just swept up the country way more? Like, would it be wrong to say that more Koreans own double and triple levered ETFs than the average American?
I don't have the exact numbers, but I do know that Korea had 1 out of 3 or 1 out of 30 people get margin called in one day. Day. Like literally, think about that for a second. Margin called. All your brokerage account is gone in one day. 3% of the population. So that'd be 9 or 10 million people in America.
That's crazy. Like, that's nuts. There's too much speculation. And then, and going back, bringing this back to, Japan, I believe that some of that at least is being caught up in those NISA accounts. And that they're in there, and like, and so like I just, you guys have been great. the Japanese yen bears have been terrific. Great call. Good for you guys. I think you're overstaying your welcome. I think that, and when I start to hear the confidence upon which they're predicting, like, oh no, not 200, now 250, like, I'm like, no, like, there's a point where,
if you think about it, right, that go back to the 80s bubble, right? Like, that bill got deferred. Now, they did some consolidations, a few banks went out of business, but what they did was they suppressed rates. They were the original QE guys, right? And then basically, by letting that become the floor funding rate for the world, they passed the bill on to the world. And so if we're going to reverse it, the bill's going to come due from the carry trade and from that money coming home and the carry trade unwinding. And so this is not just a yen story. This is a global market story. And
the trouble that also feels like hyperbolic, and I don't like that side of it either, because I think it could just be like a situation where the Japanese government says, hey, wait, this doesn't make any sense. We want to do Japan, make Japan great again. And the reality is that our oil's too expensive. We got too many tourists. The purchasing power of our citizens, they're complaining. So how are we going to fix this? Well, we want to spend some money at home anyways. Let's, we don't want rates to rise. Let's just bring home our money. I just don't think it has to be this hyperbolic either way. It doesn't have to be 250 or like a blow up and it's going to go back to 75, right? It could just be.
I hear you, but I'm just saying the major macro trade has been yen funding for 15 years. Okay. Yeah. And then basically if they're really going to be, because remember, I have a chart in here, Rupert, somewhere where like we're still a negative 100 basis points real on the overnight call rate.
I'm not going to find it now. I'll put it in the show notes. We've got it in there.
And so they can't really afford positive real rates. And so
so here I'll just briefly go on to this. I that's also makes me mad. They can't afford. First of all, one of the things is that if you go look at their GDP as a percentage of their debt as a percentage GDP, right? Like everyone goes, it's 250%.
You got to net it out. You got to net out their cross holdings. Yeah.
Okay. So meaning, and for those who don't know what Benny's talking about, it's in essence half of it is owned by the Bank of Japan.
Yeah.
And so you have a long on one side and a short on the other side, right? And to me, I understand why they don't want to, but I would just like, in my mind, I have to flatten it because they're both government entities. It doesn't matter. And it doesn't matter. So like really they're 125% of GDP. And I think that they could have a situation where they start to raise rates, but the reality is that if money starts coming back and the currency starts helping them on inflation, they might not need to raise rates as much as you think they need to raise rates. Like they're the ones with the capital. Like I'm more worried about countries in this day and age that don't have the capital, that have big deficits. And one of the things is like, if you think about it, like who is borrowing the most out there? Like who is the world's biggest borrower? Like it's the US. And so you have the most overvalued currency, the most overowned stock market, and it's not only is it overowned, it's the most concentrated it's been in how many years, decades? Like I think in 1929, it was this level of concentration. In the 60s for the Nifty 50. And then I think in the 2000, we're in this thing. So we have the most concentrated market and the concentrated over, things. And it kind of makes me laugh when people start talking about Japan being the problem. Like Japan's not the problem. Like, that's not it. Like even China, I look at China and I go, yeah, okay. So their stock market's not doing that well. But the reality is in terms of their actual economy, they're continuing to make more things, right?
But,
like they own, like, listen, like, let's put aside the financial engineering. Like you were the one who sat here and told me how all this is just financial engineering and it's just one smoke show over another. Right. And so then we got to ask ourselves, okay, so the assets on this side are all these overpriced, inflated, AI companies. And then on the other side, we have stocks that haven't performed that great, but actually in terms of producing and creating things, like the Chinese went and just, owned the car market in a space of like 6 years. And so I know people hear this and they'll be like, "Oh, you're a China sympathizer." I understand all the negatives about China as well. And I'm not sitting here saying that I like one or the other. I'm just saying let's just be aware of the narratives and the pricing and what's actually happening in the economy and think about those things. And I think we've lost track of financial versus real.
Yeah, but I guess what I'd say to that is, and we should talk about that, is like, Evergrande was in May of 21, right? And Evergrande was like, we can look back at as like the countrywide moment of their real estate market imploding, right? And since then, their bond market has been the best bond market. And so I think that 2%, you need to get the Chinese 10-year above 2%. You need to get like that will be the tell, because until then, I think a lot of Chinese money has left. I think they're also been in Bitcoin and they've been in gold and like there's money that's flown out of China because they don't look at the domestic market. And look, Rupert and I met over talking about BYD because I was a mega China bull in late 23, early 24. And I knew, Rupert had worked in China EVs and we talked, well, BYD is a better company than Tesla, but it trades at, a fraction of what Tesla is, right? And so there is mechanics going on independent of that you need to be like aware of or respect, I guess.
Okay, so in terms of BYD, I think that's a great example of what we were talking about earlier with the AI. The reality is that EVs did change the world. You go look at China; they've completely and utterly changed their entire society, and they've made them extremely affordable. They've basically got themselves off of gasoline to a large extent, and yet the companies made no money because there's such intense competition. And so one of my big complaints about this market, and bringing it back to our earnings bubble, when people start telling me, "Oh, look at these earnings, they're making so much money," and I go, "Look at the margins," and I think, are you telling me that margins are not self-correcting? Because like as Jeremy Grantham says, the reality is if they're not self-correcting, that means capitalism has failed, right? Like earnings should be, or margins should be self-correcting, and they're not. And so my question is, why are they not? Like in some ways, we're having more intense competition in China than we are in the US.
I mean, but I guess that's my point, is that like when we come to circle this back to the LLMs, intense competition, capital heavy, not good for capital holders. Right?
I completely agree.
Farther than China for that.
But then we have to then ask ourselves, who has trouble funding stuff? Because the reality is all the money is in the US right now, funding these, what you and I and Rupert believe are uneconomical, AI spends. And so where is that capital? What's it going to do? So I think the capital is going to go home. I think the China, I suspect that it could be one of the better performing stock markets.
I totally agree with you, Kev, on this. We're talking about a sequencing. I'm saying I think there's one more move, right? I think there's one more.
Could be. Yeah, I'm not gonna push back on that.
The long-term trend, the next decade, next 5 years, whatever. Like I think that we're getting close to the turning point. So just so we're clear, I do agree with you. Timing is always the trickiest mistress in markets.
Yes.
Yeah, I listen. I think it is this sequencing thing. I agree with Kev around the repatriation trade generally. I'm just a bit more worried about the damage that it does on the way. Right. I mean, I ultimately agree that a revaluation of US equities will lead to, or revaluation downward of US equities, given in a hyper financialized economy, will lead to, I know recessions are outlawed these days, but will have an economic impact, which will drive people into the safety of fixed income again, probably.
Yes.
But that is a perfect arc. I just worry about the ruts on the road getting to that.
The other thing is, though, like if you go look at the total return of the bond market, it has a coupon now. Like that's the other, right? Like it's okay. Like, the rates are going up a little bit, but go look at your total return. It's not that bad. right? Like in the old, like everyone loved it at 1.5. And like where all you could do is like it was a greater fool. You had to sell it to somebody for even less in terms of the yield because you weren't making anything on the coupon. Nowadays you have a coupon, and it just doesn't feel like. And the other thing is, I happen to believe that the Fed is going to be more hawkish than folks realize, or sorry, not realize, that they expect. And if they're more hawkish, I know you might, like a lot of folks might say, well, that doesn't make any sense. Why are you bullish bonds? And one of the things you need to realize is that the worst thing a long bondholder can have is a very, dovish central bank, because the dovish central bank means that they're going to tolerate inflation. And inflation ultimately is the bondholder's worst nightmare. And so if we have a hawkish Fed, then that again, it's good for the long end of the bond market. So,
which is why Lacey Hunt's just gone bearish. He thinks that they're not going to. Right. This is the other side of the trade.
So so I haven't read it yet. So is that basically his argument?
Basically he's worried about long-term inflation and the long bond.
And that's significant because he's been a pretty persistent deflation guy.
Pretty persistent.
I mean, like if you're like, hey, one guy who's been like buy bonds for like 2 decades, like I think he's your guy.
I know, but are you making the case for long bonds, or are you making the case against it? Because I might argue that somebody that has been wrong for the last 6 years, because bonds have been done poorly for the last 6 years, and is finally giving up on his bullish bond call. No disrespect to him. I don't, he seems like a very nice guy, but I know when I have a bad call, I don't go from like very bullish to extremely bearish, because I know that's going to be wrong. Like I just know it. I know it in my heart. And the only reason I know it is because I've done it so many times, right? Everyone has, right? Like you don't go from like being the biggest bull out there to the biggest bear. And that's what I worry about when I hear that.
But I guess the one thing I'd say is I like the steep, right? Like, cause so I don't know what happens in the long end. As Rupert knows, I've not like, look, it's been a good flattener. But like, I think that this war hawkishness is just BS. If you think about 2008, we had the oil move, we had a China capex boom, we had a housing capex boom, and then we were at deflation and zero by the end of the year. These things can happen fast when credit's involved, right? And so basically, I think that once you realize that all this private credit is what's funding AI, because again, we're at negative free cash flow now, SOFR funded, well, they're going to have to take SOFR down. Like, so I'm very confident in my Z7s, even though I've got my ass handed to me for the last couple months. But like that, I'm much more confident in the long end.
So going back to your argument about sequencing, I might not disagree with you, but I think that there's flattening first that then ultimately causes the steepening.
What happened?
Right.
So, and that's what's happening right now, right?
Right.
Like,
that's been my call for a little while now, is that I think that the Fed has been more hawkish. Like I see the market. The other thing that's interesting, and I haven't figured out who's doing it or why, but there's been a huge seller of August Fed funds. And so a seller means somebody is betting on higher rates. Now, some folks believe that there is a lot of the basis trade where they fund bonds against the futures. There's a huge position in that, and some of these guys might just be hedging that.
Yeah.
But when I heard about this seller, it just reminded me. I remember in late 2021. And there was this monster, I think we were trading Eurodollars back then instead of SOFRs. Yeah. And there was like this monster Eurodollar put buyer. And they were just there all the time. And they're just buying and buying and buying. And no one's ever said anything, but I'm assuming it was Jamie Dimon. And because you see him and JP Morgan talking about how he was worried about higher rates. And they would do things like, I think, well, what were they doing? They would run out of, they would clean out the pit and they would just buy it all. And then they would do spreads because that was the only way the guys could sell it to them. And then they were figuring out different positions, but it was just constant and it was so right. And I'm not sure about this because it's not in the same league and it's obviously not an option position. It's actually an outright, but this strange monster seller of Fed funds for this particular meeting, almost feels like someone knows.
Interesting.
Well,
listen, on that,
the last thing I'd say, the Fed has a history of doing the death shot. They did it in June of 2000. They did it. And people don't remember, they almost raised rates in August of 2008, which seems crazy looking back. But if you go on the long transcript, that was one of their options to raise 25 bips. In 1929, they raised. In 70s, they did. Like that's what they do. They do the death shot at the end.
Yeah. So I listen. It's still an unlikely event, or at least it's improbable. Like it's like the market's at like 15% or 10. It varies between 10 and 20% depending on how much this guy in the Fed funds futures leans on it. So I'm just saying I think it's closer to 50-50. Now, like 50-50 still means that half the time nothing happens, right? But I think it's closer to 50-50.
It's a big shot when it does. Listen, Kev, we are going to wrap it there. Tell everyone, if they don't know already, how they can find you.
They can come to themacrotourist.com and they can send me an email, Kevin at themacrotourist. I'm happy to pass some stuff on. Thanks a lot, guys.
And you're totally okay when they come there just for the pictures. I agree.
That's right.
Thanks so much for joining us, Kev.
Thanks, guys.
Benny and the Squirrel and the Macro Tourist out.